This is Module 15 of Accounting 3110, and this module is going to continue looking at a standard costing system. Last time we looked at variances related to materials and direct labor. This particular module is going to look at the overhead variances, especially the variable overhead variances and the two fixed overhead variances. For right now, let's go back to the prior module, which was Module 14, look at the for practice, and review a little bit about the variances related to materials and labor. In this particular problem, we were making 10,000 jackets. And for every jacket that we would make, it requires 2 yards of material, and each yard at standard would cost $2 per yard. And so as we look at the information in this problem, trying to compute what we're going to call the price variance, we're going to look at the actual quantity that was purchased. And please note that we're going to use the purchased amount when we do this price variance. And on this side, we'll have the actual price, but what will change here in the middle, we'll still have the actual quantity purchased, but we'll use the standard price. So when we do these calculations, let's fill in what we know. We know the standard price is $2 per yard. The actual quantity purchased was 25,000 yards, and I found this rate of $1.75 per yard because I was given this total. $43,750 was the actual amount I spent on these 25 yards of material. So typically you'll be given the total and the yards or the quantity, and you can back in to the actual price. So we have the quantity over here at 25,000 yards. And again, what are we focusing on? We're focusing on AP, actual price compared to standard, and we can see this is going to be a favorable variance. This is going to be 50,000. And the difference turns out to be $6,250 for the price variance. Because the actual price was less than the standard price, we have a favorable price variance. Again, the point to catch is that when we compute the price variance for materials, we use quantity purchased. Now we want to look at what we're going to call the quantity variance, and in this particular material variance, we would use our actual quantity that we used in production, not purchased. So we used 23,500 actual yards. The standard price is $2. The standard price over here, $2. And think about now what we're looking at. We're not looking at the price because this is the same for both, but we're looking at the quantity that was used. The standard quantity is always going to be your actual output times the standard quantity per unit. Actual output times standard quantity per unit. In this particular case, we were making 100,000 jackets. This was our actual production. And each of these jackets was to use 2 yards of material. And let me correct this just for a minute. This is not 100,000, but this is 10,000 jackets, and each one is to use 2 yards of material. So our standard quantity, which is the amount of yardage we should have used, would be 20,000. So again, my error there, this should be 10,000 jackets times the standard quantity of 2 yards of material per jacket. So we get 40,000. Should have. And over here we are going to get 47,000. and we're looking at the amount of yards we should have used compared to what we really used. And of course, this is going to be unfavorable, and the amount will be $7,000 unfavorable. So before we leave these first two questions on the for practice, let's go back to each of these and give an example of what could have happened here. We had a favorable price variance. Of course, the actual price was lower than the standard, and maybe we bought a large volume and got a quantity or a volume discount that may have allowed us to buy it for a cheaper price. The other thing is maybe we found material that was cheaper, perhaps of lower quality. Either one of those would be reasonable explanations. And it is favorable of $6,250. So what this is saying is, because we were able to get the material for less, this actually caused us to have $6,250 more profit. Let's go to the quantity variance for materials. It was unfavorable. Maybe we have purchased inferior or lower quality materials, and thus we have more waste. This would be a reasonable explanation. Again, there are multiple reasonable explanations, but the point is we want to think about what could have caused such a variance. Maybe it has to do with the workers who are using these materials. The workers are maybe not properly trained and there's extra waste. Because we had extra waste or extra scrap, this had a $7,000 unfavorable effect on the profit. Let's go to the labor variances now, and we're dealing with 10,000 actual jackets being produced. The standard says it should take 1.5 hours, and the standard rate of pay that was in the budget was $9.60 per hour. So we know the standard rate is $9.60. What we want to do now is look for the information to complete this. We had, on direct labor, we had $160,050 of direct labor. And this represented 16,500 actual hours of labor. And so when we divide that out, we get $9.70 for the actual rate. So we were given these two, and we can find the rate. We will put the actual quantity here. And so when we look between these two, we're looking at the different rate. The rate was higher than we planned, so it's going to be unfavorable. When we do this, we get $158,400. So we can determine that there was a variance here of $1,650 unfavorable. Let's look at the efficiency variance now. If we're making 10,000 jackets and they each take 1.5 hours, we should have been using only 15,000 hours, so this will make this unfavorable. We used 16,500. And when we compute this, we are going to get 144,000. And this will cause us to have an unfavorable variance of $14,400. Actual on the left, should have, or standard on the right, and this must always be computed. How many hours should we have used to make this many jackets? What could be going on here is perhaps we tried to get more experienced labor, and this caused it to be a little more expensive. However, even though we spent more per hour for the labor, we have quite a bit of inefficiency here. And so perhaps this had to do with machines breaking down. So it took the laborers a lot more hours. Again, just wanting you to think through what might be reasonable explanations. Let's return now to this module and the subject of overhead variances. Module 15 is actually going to start with a discussion of types of budgets, and this will precede our discussion of the variances for overhead. Companies can prepare what we call a static budget, or they can prepare what we're going to call a flexible budget. And a static budget is going to project cost for one particular or one given level of activity. When we look at a flexible budget, it's going to look at projected cost at multiple levels of activity. So I'd like to show you an example of each of these types of budgets. This is a static overhead budget. And the reason I know it's static is because it's only going to estimate cost if we're producing 40,000 units. In other words, there's only one level, 40,000 units produced. We take a cost formula, we plug in the 40,000, and we get our estimated overhead cost. One level. Here is a flexible budget for that same company. If you'll recall, at 40,000 units, the estimate was $925. Well, here's the 40,000. We've just presented it in terms of variable, fixed, and total. But here's 45 or 30 or 35. So what this particular type of budget offers is that if it turns out that we don't actually make 40,000 units, we only make 30, then this is the estimate that we would use. Likewise, if it turns out we're producing 45,000 units, then this is the best estimate of what overhead costs should be. Now, in this particular example, we used the activity level of units produced. This would be considered output. Units produced would be referred to as output. If a company only makes one product, it's quite all right to use units produced. But if a company produces multiple products, and each of these products requires different amounts of resources, it would be better here to use some kind of input variable such as machine hours or direct labor hours instead of an output variable such as units produced. The flexible budget has a lot of benefit for management because they can kind of do the what-if analysis. If what would the costs be if we were at this level versus a third level. So again, a very good management tool. Let's talk about the variances now for overhead. We want to split the overhead into the variable overhead and the fixed. It's very important as we do these variance calculations that we have a really good picture of what an example would be of this type of cost. So variable overhead means that it's an indirect cost and it increases proportionately with activity level. So let's find an example. It might be the wages of a security guard. A security guard would be considered overhead because it's an indirect cost. You can't tie this to the product. It would be considered variable because we are paying the security guard per hour. And so when we look at a variable overhead situation, this is going to be a really good example for us to think about, maybe the wages of a security guard. Another example might be indirect materials. Those would also be indirect, and they would also be variable. So you could choose perhaps one of those two examples as we talk about overhead variances. We're going to look first again at the variable overhead variances. So just think in terms of variable. Think in terms of perhaps that security guard's wages. This company is a company that produces tents, and their overhead cost formula is $30,000 of fixed plus $6 times every machine hour. So machine hour is what we would call the cost driver. And in our example that we're going to use, we have production of 3,000 tents. This is actual production. This is how many tents were actually produced. And because the cost driver for this variable overhead is going to be machine hours, we're going to need to know that for every tent we make, it should take 1.5 hours on the machine. So let's fill in what we're told for this example. And in the manufacturing environment, there would be a counter on each of the machines, and they could come back and easily find how many hours the machines ran. 4,800 hours. In our accounting system, we'll keep track of the cost, and we can determine, in this case, it was $30,480 of variable overhead. Using these two numbers, then we can find the actual rate for our variable overhead. Now, using our cost formula, our standard rate is $6. So we have just about every number now that we're going to need, because we know that actual machine hours are 4,800. Keep in mind that this is set up like our materials and labor, where we have our should-haves on the right, we have our actuals on the left, and what goes in the middle would be our actual machine hours, but our standard rate. Now, to find our standard hours would be, we produce 3,000 tents. They should have taken an hour and a half each, so this would be 4,500. So let's fill in all the blanks. We get 27,000 here. We get 28,800 here. And we can see, if we isolate the actual machine hours, that the rate was higher than we planned. So the spending variance is unfavorable by $1,680. Now let's talk about what that could mean. And we'll use our security guards' wages as an example. An unfavorable variance here could mean that perhaps the security guard, for, again, just as one example, maybe he's making more per hour than we budgeted or we planned. Maybe he's gotten a recent raise. Another explanation for the spending variance would be that we simply have to use him more hours than we planned. Perhaps there's been a lot of theft in the area where this production facility is located, and maybe we only plan to have security guards there during the week, and now we're going to have to keep them there 7 days a week. So something is causing this spending variance, and it could be either of those items in the context of a security guard's wages. Let's look at the efficiency here. The efficiency variance is about the efficiency of the cost driver itself, and it's no more complex than that. So what we're saying here is we should have been able to do this work in 4,500 hours. It took 48, and this is an inefficiency, an unfavorable variance of $1,800. So this variance on this side will always be about how efficient the cost driver is, or the use of this particular activity. 4,800 being more than 4,500, causing this to be an unfavorable variance. let's start to look now at the fixed overhead part. And again, we're going to continue on with this same example where we're making tents, 3,000 tents, and each requires 1.5 machine hours. And again, this is our cost formula. And of course, now we're focused on this part of the formula, which is the fixed cost. So this becomes our budgeted amount right here is 30,000, straight from the cost formula. The accounting system is going to keep track of all these costs and would be able to provide this information at the end of the period that we actually had fixed cost of $32,500, even though we budgeted for 30. This is called the budget variance. And in this case, it's $2,500, and it's unfavorable. And it's very simple. We simply spent more for fixed overhead items than we had planned. Let's take an example. Maybe this is rent on the production facility. Well, perhaps we had an increase in the rental agreement, and we're having to spend more for rent than we had planned when we did the budget. So nothing more complex than that, just costing more than we planned. Now let's go over here, and this third category here, or the third column, is going to refer to what we call applied overhead. And we are familiar now with the standard machine hours. We know that 3,000 tents should take 4,500 hours to make. Now, what we do have to talk about is one other bit of information that hasn't been disclosed yet about this company, is that when they did their budget, they planned two different things in regard to fixed overhead. We know that they budgeted $30,000, and this is their fixed overhead. But they also had to determine before the year began, when they did the budget, how busy they were going to be. And their plan, or their budget, was for 4,000 tents. So if it's 4,000 tents that they put in the budget to produce, and each of them takes 1.5 hours, then what we see here is a projection of 6,000 hours on the machine. So when you divide the $30,000 by the 6,000 machine hours, you get the rate of $5 of fixed overhead per machine hour. Now, this is what we would have called in an earlier module the predetermined overhead rate. How many dollars do you put in the budget, and how busy do you plan to be? Now, we know that we turned out to produce only 3,000 tents, but the budget plan was to make 4,000, which requires 6,000 machine hours. So now we can compute this last area. This gives us 22.5 for the applied. And this is called the volume variance. This is the budget, and this is the volume variance on the right. The volume variance is always going to indicate whether we produced more than we planned or less. In this case, we planned for 4,000 tents. We only made 3,000. So I can tell you this will be unfavorable because we were at a lower level of production than what we planned when we did the budget. This is $7,500. So budget variance in regard to fixed overhead is about just whether you spent more or less than the budget. The budget comes from the cost formula. When we talk about the difference between the budget and the applied, this has to do with whether we were producing more or less than we planned to produce. And this was unfavorable because we actually produced fewer tenths than we planned to produce. This discussion of these variances leads us to the final subject we want to talk about, and that is when we have a standard costing system, the costs that move across the flow chart that we've used all semester is the costs move across its standard. So when they get to the final stage, which is to be the cost of goods sold, this is going to be at standard as well. When we go to prepare our financial statements to go outside the company, our external statements, we have to use actual cost of goods. Because the flow chart was all at standard, this cost of goods sold that is produced on the flow chart is at standard, and it must be updated to get it to actual. So let's work an example of how we would do that. Again, just a quick demonstration of our flow chart, our materials, our labor, our overhead, all of this flowing this direction, and all of it flowing at standard. And so when we get to work in process, we get to finished goods, and we get again to the final stage, cost of goods sold, it will also be at standard. And what we have to do, and I'm going to assume this number turns out to be $500,000. What we have to do is recognize that we're going to have some favorable and some unfavorable variances. And I'll keep this list short, but let's say that we have a direct material price variance of $10,000 unfavorable. And maybe we have a direct labor efficiency variance, and it's $5,000 favorable. And maybe we have a variable overhead spending variance, and it's $3,000 unfavorable. And we could go on through all the variances, but this will be enough for you to see how we go from a standard cost of goods sold to an actual. Where we see the unfavorable, this means not enough dollars were sent through. The costs were greater than this. So we would take our $500,000 that's at standard, and we would add all the unfavorable variances. So we add the unfavorable to get it to actual, and then we actually subtract any variances that are favorable. The reason we do that is because we sent too many costs through at standard, and it turns out the costs were less than at standard, which means they were favorable. So we add the unfavorable, we subtract the favorable. And so the actual cost of goods sold for this company that would go on their external financial statements would be $508,000. So this was converting a cost of goods sold at standard to a cost of goods sold actual. In conclusion, here in Module 15, I want to remind you again of the purpose of a standard costing system. It truly is a control device. If we can help management see what our costs should have been and what they actually were, this is a first step to managing those costs. And so even though we have very tedious calculations when we calculate these variances, let's don't forget that the whole purpose of such a system is to help management do a better job of controlling cost.